Most of us like to have a sense of control in our lives. This week, we're going to talk about why that same need for control can sometimes lead to bad investment decisions. This week, we're going to talk about why that sense of control that all of us have can sometimes lead to those bad decisions that can affect our long-term financial plan. Now, I use a few charts actually, when I give 401k presentations to help young people understand just investments as a whole and how our behaviors and our emotions come into play. But I think those same charts can really paint a picture now, especially in the environment that we are in, for any age range, wherever someone is in their investment life cycle. The first slide I'm going to touch on today is called the retirement equation. And basically it breaks down the areas of our financial lives and where we have control. Now there's certain elements that we have total control on, and that's how much we save and spend and how we invest. We can't control market returns, as you can see there in the blue, but we can certainly control the risk profile that we take. Now, there's other areas of our lives where we have some control over, and that's employment and duration. How long do we work? When do we retire? When do we make those big financial decisions? And we have some control over longevity, and that is basically if we eat healthy and exercise, we should live to a ripe old age. But today we're going to talk about what happens when we focus too much on those areas that are completely outside of our control. Now, when it comes to those areas, and that is how we make decisions on the investment portfolio, i.e. based off of market cycles and where we're at in those market cycles, and how we adapt and maneuver through these investment cycles based off of what the government is doing, what policy changes may come into play. Those are those areas where we can really hurt our long-term financial plan if we let that need for control take over. I've been having a lot of conversations with clients here recently about the market volatility that we're going through. And whether that's someone who is well into the accumulation phase of their investment life and they're in a more growth-oriented portfolio, we're seeing some downturns, which I know for some are scary. Now, on the opposite side of that, we have clients who are in the distribution phase of their investment life cycle. And even though that downside may be more muted, it still doesn't take away from those emotions that we feel when we get into these volatile markets. I've said it before, and I'll say it again, the same part of the brain that gets triggered when you're in mortal danger also gets triggered when you lose money. Smart people can become very irrational very quickly. So, my second slide that I'm going to highlight today is one that Dave shared 2 weeks ago, but I think it's important to look at through the lens of control. Now, as we can see, this slide talks about the impact of being out of the market. So, just to sum it up briefly, if someone were to put $10,000 into the S&P 500, the US stock market, on January 1st of 2002 and held it through December 31st of 2021, as you can see, their average rate of return during that time frame was 9.52%. And that $10,000 turned into $61,000. You can see that next bar graph over shows that during that 20-year time frame, if we missed even the 10 best days in the market, we cut our overall rate of return by half. Now, some contrarians will say, well, what if we miss the worst 10 days? Well, my response to that is, if you have the crystal ball that'll tell us exactly when to get out and when to get back in, sure, we can have that conversation. But until then, as we will note in this chart, 7 of the best 10 days over that 20-year time frame occurred within 2 weeks of the 10 worst days. And if we go back more recently to March of 2020, during kind of the first downturn through COVID, we ended up on March 12th with a down day that was almost double digits. That was immediately followed by an up day of almost 8%. That need for control means we want to hit the panic button and get out of the market. We've talked at length about why we want to stay the course. But just to reiterate it one more time, the only time we actually lose in the portfolio is when we sell. And although it may feel like control to hit that button and go to cash, the hardest part is, when do we get back in? And as that chart we just discussed alludes to, it's very difficult to time the market and understand when is that next upturn going to occur. So for those of you who are in the accumulation phase, right now market volatility can be a good thing. Every time, whether it's on a weekly or monthly basis, you're putting money into your portfolio, whether that's your 401k, your brokerage account, or any other investment you have, you're buying shares on sale. And for those of you who are in the distribution phase, or maybe taking dollars from your portfolio, if we have done our job, which is to build our portfolio that aligns with your financial plan, we've run these scenarios. We know that the income that you're generating and your plan says that you're going to be okay, as long as we don't look to that part of our brain that tells us that we need control. And by control, we end up making bad decisions when it comes to our investment portfolio. These are those times to have conversations with us if you're starting to feel that itch to make a bad decision. We'll stay the course. We will not get emotional about the investment decisions in your portfolio, but we always know that it's a good time to talk that through as well. To wrap this up, markets can certainly be scary in the short term if we let our emotions and our need for control come into play. Long term, they're efficient. We will weather this storm and we will come out the other side in a good place as long as we make good decisions right now. Thanks for taking the time this week. We'll talk to you soon.